Hi everyone, very good evening. My name is Kailash Upadhyay, and our today's topic for this webinar is project selection techniques. Okay, so I am certified PMP professionals, and I have done my MCP Microsoft certified professional as well, and I do lots of other training in MCT, which is Microsoft certified trainer, and do lots of training on Microsoft product, and plus IT infrastructure library, IT service management and all. So those are some of the certification which I have done. So let's begin with our today's webinar on project selection techniques. So before I begin this this webinar, I just want to check what is the project manager role in project selection techniques. That's an open question to the attendees. If you can just tell me what should the project manager do in project selection, what is his involvement. You can just raise your hand, or you can write your answer into the question answer panel, so I'll able to respond to you. Anybody? Okay, so let me start. Project manager as such has frankly saying no role in project selection techniques. Project manager is being identified into initiation phase of the project, and during the process of project charter authorizes the project manager to use the organizational resources to achieve the objectives of the project. Okay, so why are if project manager has no role in project selection, so how this project selection technique can help in PMP exams and all, or maybe what should be what benefits should the project selection technique this webinar should help in project managers. Okay, so if the project manager knows what is the strategic objectives of the project, what is the funds coming from, what is the duration of the project, why the project has been selected from many other projects, if all these things are known by a project manager, he can give better value to the project, and he can tell the sponsor that whether I hope people can hear me clearly. So project selection, the project manager will able to justify to the sponsor that the cost and the benefit is achieved or not. So that's the importance of project manager knowing why his project the project has been selected and what is the importance of the project. By knowing all these things, the project manager will able to do better justice and will able to achieve the organizational objective being defined by the project. Okay, so this project selection is done in pre-project initiation phase. Before the project is being actually initiated, there is lots of background studies has been done by the sponsor, by the customer, or maybe the project selection committee, which we call. Okay, so what does happens in pre-project initiation phase of a project? The committee is identified by the sponsor and customer, and this committee is from different functions, like there will be business analyst who will be writing the business cases, and there will be functional team who will be functional member functional team will be identified, and they will be identifying different projects and the objectives of each and every project. So during the pre-program initiation phase, project objectives are identified, and these are the strategic objectives which the program has to deliver. During this phase, we also prepared business case. Remember, project charter has an input called business case. So this business case justify the project selection. Can anybody tell me what is the project business case will contain? Anybody from the participant? You can please raise your hand so I can unmute you. Okay, let me unmute Gautam. Gautam, can you please
Yes,
hear us now?
I can hear. Can you hear me?
Yes, yes, we can hear you, Gautam. Yeah, please tell me, what is the project business case?
Okay, great. So as you rightly said, project business case is input to the project charter. Now,
Right,
business case will define what is the objective behind doing that project. What is the need of doing that project? A quick background of the details on which you are initiating a project, why this project is needed, what will happen if it is not done, and further details stating the basics of the project. So, for example, suppose I want to do a project of, say, I'm working for a telecom company, order management work. Okay, and I want to improve the productivity of order management process. So in that case, my business case will first take, okay, what work I am doing for that telecom management company, what the order management is all about, what is the scope of the work, and then why is the need for that productivity improvement. And if
great,
that is not done, what will happen? And if that is done, what will be the benefits?
great.
So in a quick snapshot.
Yeah, that's really nice justification, Gautam. So project charter will also have the cost benefit analysis, that also, when what will be the return on investment, how soon I can get my investment back, something called payback period. So all these things will be part of project business case, and these becomes and every projects in the organization, there will be multiple projects, from one will be selected, because it will not only be possible to select each and every project from, different function can recommend different project, so it will be only one project which will have highest return on investment, highest cost benefit analysis, those will be selected. So this business case will primarily will have the cost benefit analysis of the project. Okay, so that's good. So let's continue. So other than, this pre-program preparation phase, we also identify project manager, that who is the right project manager, who can deliver this value within time, within budget, and who can achieve the strategic objective of the organization. So project manager is identified during pre-project initiation phase, and then that is being nominated into project charter and has been authorized to use the organizational resources for the project. So identify project manager is identified. More, beside identifying project manager, the committee also identify the checkpoint. The checkpoint means, the different phases. The project may be done. If it's a multi-year project, if it's a large project, the organization would like to have a checkpoint after every year where the current project is standing, where the different phases the project will be done. And if one two phase has been completed, then to continue and evaluate project and continue with the project. Okay, so these checkpoints, that at what point the organization will do the cost benefit analysis of the project, the return of investment, that what company has invested, whether it is able to complete the project and able to deliver the project, will able to deliver the value. All those checkpoints will be defined into pre-project initiation phase. Okay, so now let's understand. As I said, project charter uh, project charter authorizes the project manager to use the organizational resources, and this business case and this project manager will be input to the project charter, or maybe even sometimes the objectives, the assumptions, the constraints, all those things will be part of project charter. I hope you have seen have gone through a sample project charter, or you have prepared in your day-to-day project management activities. So that's what project charter will have: input business case, the project manager will be there, the high level cost, the schedule, and the objectives, constraints will be part of the developed project charter. Let's understand. We said about on the business case we will have cost benefit analysis. Let's understand what are these different mechanisms by which the organization can select among many projects. So one of the techniques, analytical technique, is cost benefit analysis. So what is cost benefit analysis? Cost benefit analysis compares the expected cost of the project to the potential benefit it could bring to the organization. That means what the company should actually put into the project, and at the end what the company will have in returns, what the benefit will company will have. So it is basically the expenditure versus the return the company will have. For project selection, benefit are same as revenue. Remember, revenue is not same as profit. So profit is what profit is, you know, the revenue minus the cost will give you the profit. But for project selection, you have to say, you have to understand, we will only considering revenue. We will not consider profit. Okay, let's understand the benefit cost. If the benefit cost ratio is greater than 1, that means benefit are greater than cost, and benefit cost which is less than 1 means the cost are greater than the benefit. Okay, so let me put a simple question in front of you, and let's try to understand what does a benefit cost ratio of 1.7 means. Can anybody answer this question, please? What should be the benefit cost ratio? You can use the question and answer panel to give your answer. Gautam said B. Every $1. Okay, Nilesh is saying B. I'm just waiting for a few more answers. Somebody said C. Okay, Ramya saying C. Okay, so B is the correct answer here. As I said into my previous screen, for project selection we will use revenue, not profit. Okay, so cost benefit analysis will compare revenue against cost, not profit against cost. So cost benefit ratio of 1.7 means revenue is 1.7 times the cost. That means for every $100 we probably be getting 170 as a revenue. Okay, so revenue is 1.7 times the cost is the correct answer. Great. So I hope you're able to understand for the project which is having highest cost benefit value, that project will be selected among the many other projects. Let's understand some of the other techniques to select the projects. Okay, there's another method called present value, or something called net present value. Okay, so what does present value means? Present value means the value today of future cash flow, and the formula to calculate present value is PV equals to FV divided by 1 plus R raised to N, where PV is present value, FV is future value. So can somebody tell me what is, let me put this question in front of you. What is the present value of 300,000 received 3 years from now if we expect the interest rate to be 10%? Should the present value be less or more? Anybody? If you, it's a future cash flow of 300,000. What should be the present value of 300,000? Okay. Let's put, so present value, let's put the into the formula 300,000, which is the F 300,000 which I'll get after 3 years. So that's my future value. 1 plus R. R is my rate of interest, which is 10%, which is 0.1, and after 3 years, which is N, number of period 3. So 300,000 divide by 1.31. So there is a small numerical mistake here. So consider this as 300,000 divided by 1.31. So the value will be 225,394. So the present value of 300,000 which you're supposed to get after 3 years will be less. So just understand this formula, and we will use this present value formula into net present value of a project. So let's understand what is net present value. It is a present value of total benefit. As I again said, benefit is income or revenue. It is not a profit, minus the cost over many time period. Calculating the net present value of each possible project provides a means for the organization and select the best project to initiate. Basically, the net present value, if the net present value of a project is higher, then that project will be selected. Okay. Generally, if net present value is positive, the investment is good choice, unless even a better investment opportunities exist. Okay. So let's understand and question. An organization has two projects to choose from. Project A takes 3 years to complete and has a net present value of 45,000. Project B will take 6 years to complete and has net present value of 85,000 to complete. Which one is a better investment? Anybody, guys? Anybody, which project you will choose? Project A or project B? I'm getting somebody saying project B, project B. Okay. So the correct answer is project B. The number of year is not relevant here because in net present value you have already considered the number of years. Okay, let me give you another example in my next slide to understand why project B is the better option. Okay, so here to calculate net present value we need to calculate the present value. So we have seen the present value formula, PV equals to FV divided by 1 plus R raised to N. Okay, so let's understand these are the number of years for when the project is initiated. There is no income, there is no revenue. There will be a company will be putting some investment, some cost. So consider this is 200 millions is a cost for the first year. So what will be the present value of 200 million? So just put into the formula 200 divide by, so it's a first year, 1 plus 0 raised to n, it's a 0 year, so 200 divided by 1, which will be equal to 200. So my present value of 200 cost will be 200. From second year onward, I will have an income of 50, but I will have a cost of again 100. So what is the present value of 50 at 10% interest rate? So 50 divided by 1 plus 0.01 raised to 1 will be same. So the value will be, okay, let me calculate. 1 plus point 0.1, 1.1. So 50 divided by, so let's understand the formula. Let's put the formula here. Remember 1 plus r, my r rate of interest is 0.1. Okay, so 1 plus 0.1 is 1.1. It should be 45. So that's 45. Same way for 100, the cost, the value, again put the present value formula. So the value 91. From the third year onward, I will have a revenue of 100 and there will be no cost. So I have already invested for the first year or for the initiation of the project. So I will have my at 10% interest 83, same as this way. So my present value is 353 of revenue, and my present value of cost at 10% is 291. Therefore, my net present value is 353 minus 291, which is 62. So that's why if in previous slide, even if you don't have to calculate any value, if the highest net present value of 85,000, irrespective of any number, you don't have to do that calculation. So if the net present value is highest, in this case, the project A net present value was 45,000 and project B net present value was 85,000. So you will choose project B. So in net present value, the number of years has been already considered. So exam will only ask you this simple formula, that which is the better investment. So the net present value, if is higher, you will choose that particular projects will be selected by the organization. Okay. I hope this net present value concept is clear. Any queries? So we can take any question on net present value. Okay. Let's understand another term called internal rate of return. Just give me 1 minute, guys. I'm facing some little bit internet problem. Just give me 1 minute. Raj, can you hear me out?
Yeah, Kailash, I can hear you.
Raj, just give me a minute.
Your voice is clear. You can proceed.
Okay. Actually, my slides are not moving ahead. Just give me a minute. I'm just trying to troubleshoot here. Guys, really sorry for inconvenience. Just give me a minute.
Okay, Kailash, you can pause the recording and then move the slide and then again start the recording. I think there might be some computer usage, or you can stop other processes which are running in your computer.
Yeah. I'll do that.
Okay.
Hi guys, I hope you can hear me out now. You can see my screen. Okay, so let's start with another concept. Just raise your hand, please, guys, if you can hear me out clearly now. Raj, can you hear me out? Okay, so people can hear me out. Great. Really sorry, guys. There is some technical problems with the network. Great. So let's understand is another techniques of project selection, which is called internal rate of return. Uh, what is this internal rate of return? That means you put money into your bank account and you expect to get return of 1%. So that means you investing something and you expect that in that business you will definitely get a return for 10%, 20%. So that's the concept. Same thing applies for us. So which project among the many project alternatives, which project has highest internal rate of returns? Okay. So that is the concept of internal rate of return. So you will not have to calculate this internal rate of return for your PMP exam. Okay. So just understand internal rate of return means the project with highest percentage of returns will be selected by the executive committee or the project selection committee. Okay. So let's have this question. An organization has two projects to choose. Project A with an internal rate of return of 21%, or project B with an internal rate of return of 15%. So which one is the better option, or which project will the organization will select? Okay, project A. Very good. Yeah, most of the people are correct. So as I said, the project with highest percentage of returns will be selected. Here in this case, project A has return of 21% as compared to project B. So project A will be a better option for the strategic committee to select. Okay, so understand for the exam point of view, if the questions comes for the PMP exam point of view, the questions comes which is the better options. So the projects with highest percentage of returns will be the better options for the projects. So this is the another in your business case. There will be another concept will be declared, something called payback period. Anybody can explain me with some example what is payback period from the team? Please raise hand so I can unmute you. Okay, Gautam is again raised hand, but I would like to have some more participant to tell me what is the payback period. Anybody, guys? What is this payback period? Okay, let me unmute Adimi. Adimi, really very sorry if I'm not able to pronounce it correctly.
Hi guys, my name is Adeyemi. From my own understanding, can you hear me guys?
Yeah, we can hear you out.
Okay, from my own understanding, it's the amount you have to, the return the business brings back to you, or the amount you have to generate, like profit, within a specific time frame. Will it be short time frame or medium time frame? Is that okay?
So you, so what are you? I'm not able to very clearly understand you. Ademi, can you please repeat that?
Okay, from my understanding, a payback period is the time that a project or organization recovers the money initially invested.
Exactly.
With profit.
Right. Thanks, Adiyami. So as Adiyami, really very sorry if I'm not able to pronounce you correctly. This term refers the length of time the organization will recover its original investment. So if the organization is spending $200 million, so when is the earliest the organization will get the returns from that particular investment? So that's the concept of payback period. Okay, so let me put you, there is a question for you. There are two projects from which to choose the organization has: project A with payback period of 6 months, or project B with payback period of 18 months. So which one is the better option, 6 month or 18 month? Anybody? If the returns is if you're getting more than 18 months, or if you're getting the returns on 6 months, so which project should you choose, project A or project B? Okay, so good. So payback, if the payback period is short, that is good. If I'm investing 200 million today, and if I'm getting the returns in 6 months, so I will choose the project over the project B, because I'm in a shortest time I'm able to recover my money which I have invested in my project. So this is a very important term which the project business case will define, that how soon the organization can get its original investment from the project. So payback period is the recovery time of the investment which company has put at the beginning of the project. So let's understand some other concept of opportunity cost. So before I show you the screen, can somebody tell me what is the opportunity cost for the projects? Anybody from the participant guys, what do you mean, how this opportunity cost can help the business analyst or the steering committee of the project to select the project? Okay, this time I will unmute Renita.
Hello, the opportunity. Can you hear me?
Yes, Renita, please tell me.
The opportunity cost is a calculation of what is expended toward the opportunity lost if you decide to select the project.
Absolutely right. So let me put a question in front of you, and if you can tell me of this question, what is the opportunity cost for project B if I select the project B? And organization, yeah, please.
If you select the project B, the opportunity cost is $85,000.
No, Renita, I think so your justification was correct. See, the project B is selected, so the opportunity cost will be 45,000, because you have not selected the project A. So the opportunity cost is the value of the project not selected. So if you have a two project A and project B, the net present value of project A is suppose 45,000, and project B is suppose net present value is 85,000. And you, as I said in my previous example, you will select the project with the highest net present value. Now you have selected a project B because it has a greater net present value. So the opportunity cost for project B is the cost which you have lost, so which is 45,000. You have not selected project A, so the opportunity cost is 45,000.
Yes, I understand. Thank you.
Yeah, great. Anybody from the participant have any query on this opportunity cost? Anybody would like to ADMB, you would like to comment on the opportunity cost? Some other example? I have unmuted you.
Yeah, from your definition, it's quite all right because we've picked project B, which is the higher NPV, and
Great.
the loss, the loss is 45,000, which means that is opportunity forgone, according to Adam Smith's definition, is the opportunity you have forgone.
Exactly, exactly. So this is one of the concept where project when the project is selected. So what is the opportunity has among the multiple project initiative? The steering committee will will choose the highest net present value project, but they will also see which is the second highest beneficial project to the company. And if the selected project is not able to deliver value, or is not successful, then the next project, maybe the organization can look into the next project, or maybe look at the next opportunity, the greatest opportunity. Okay, so that's the concept, that's the opportunity cost. The steering committee is always tracking that what is the opportunity cost of not selecting a project. Great. So so far we have done cost and benefit analysis. That what is the cost versus the benefit we are getting from the project. And remember, benefit is not the profit at the end, the bottom line, or the profit for the company. So the benefit is the cost plus revenue is called cost benefit analysis. Then we go on to a net present value. What is the present value of the project? How much is the organization has to invest among, what are the different net present value will company will give. So net present value concept we said. Then we set internal rate of return. Which project will have the highest rate of returns? So that is the mechanism the steering committee will select. Then we gone on to select the opportunity cost. What is the opportunity, multiple opportunity to the steering committee or to the organization to select from. So the company will definitely select the highest net present value, and they will also keep track of the lost opportunity. So the lost opportunity in current example is 45,000. So that will be also kept in record. So in case the project, the primary project which has been selected is not able to deliver value, or has been closed because of some or other constraints, then the next project may be initiated and may be completed by the organization. Let's understand another concept called life cycle costing. Okay, before I show you the screen, can anybody tell me what is the life cycle costing? Guys, please raise your hand. So this time I want some different hands to be raised. What is the life cycle? This is a very important term in project selection. Anybody guys? Some different hand this time. Okay, this time I will maybe the short name War. War, can you hear me out?
Yeah, I can hear you. Hi.
Yeah. Yeah.
I think it is the cost of maintenance, upgrades, bug fixing.
Exactly. So life cycle cost means when the project is selected, it is not only looked from a point of view of what is the total cost of the project. Suppose I want to launch a new mobile phone. So I will not only see the cost of that phone, but I will also see the service cost, the warranty cost. So maybe I may give the phone to in a $10,000, but suppose and I'm able to generate good revenue from it. But after launching the phone, if the phone gets have lots of warranty issues, so we have to also consider what is the quality cost, what is the customer service cost. So that is the concept behind life cycle costing. So the entire cost of the product, not only the project cost. Okay, that's called life cycle costing. Okay, so let me have this example for you. For example, the project to produce the product at a lower level of quality, and you save 9,000. What the project manager has done, he has saved some to save 9,000. He has cut some quality of a product. After the project is completed, the maintenance costs are 100,000. That means by cutting the quality, he has saved 9,000 rupees, but the maintenance cost or maybe the warranty costs are now 100,000 over the product life, instead of 20,000 in maintenance. So that means if you would have not cut the quality, you would have managed the quality, you would have invested only 20,000. It would have company's 20,000 would have gone. But now for saving this 20,000, he has definitely got a benefit of 9,000. But what has the maintenance cost has come to 100,000. So what does this means is your 9,000 project saving cost company 80,000. That means at over 71,000 additional costs. So from a project perspective, it should not only be the cost of the product, but the maintenance cost, but the warranty cost, the customer service cost, it has to be looked. So this is the concept behind life cycle cost. To save 20,000, you must have got a benefit of 9,000 at initial level at the project has ended. But post project, there are lots of maintenance issue, and which has cost company 100,000. So that means if the 20,000 would have invested, company would have saved at least 80,000. Or if we reduce the profit, initial profit which we have got after cutting the quality, so we'd have at least got 71,000 additional benefit basically. So this is the concept of life cycle costing, cost of whole life of the product, not just the cost of the project. I hope this life cycle costing is clear. Any query, guys? You can write me on the chat panel, or you can please raise your hand. Great. Now let's understand some of the other term which
Hi.
Yeah, please tell me.
Yeah, hi sir. You have give us a description of so many analysis techniques.
Yeah.
Actually, when we are considering our own project, what type of analysis we have to do? It's our discretion, or the management will decide or such thing.
It is
Being
the
a project
management.
manager,
No. See, that's what I begin my webinar with. Project manager has no role in project selection, frankly saying, because he may not even been identified during this project. This all analysis has been done in pre-project initiation phase, not in project when project is initiated. So manager or senior manager has no role. Frankly saying, it is the sponsor of the company or the steering committee, or not the head of the every functional unit may be part of this thing, and they may do brainstorming and cost benefit analysis at pre-project initiation phase, and among they will deploy or they will employ all these cost benefit analysis of each and every project which has been nominated. They will check what is the net present value. They will check what is the return on investment, and how soon what is the payback period, and what is the different opportunities the company has, which is opportunity cost. So this is done in pre-project initiation phase. But it is important for the project manager to understand that the project is selected among maybe among 10 project, 20 project, and it is closely aligned to the strategic goal of the organization. So if the project manager knows that what is the importance of the project, he may able to deliver better value or better results from that particular project. Do you agree with this?
Yeah, sure.
Great.
Thank you, sir.
Great. Yeah. Okay. So let's understand working capital. Working capital is basically the fund which company has to invest on the project. It including the investment on the. Let me read the PMBOK definition or the project definition. The current asset minus current liabilities for an organization. In other words, the amount of money company has available to invest. frankly saying, working capital means that if you remove all the liabilities and if you see what is your asset, so asset minus liabilities, what is the actual money left after that? That is the fund which the company or with the organization can use for the various projects options which the company has. So this working capital will be used like net present value, what is the cost benefit analysis, all this will be initial fund which will be declared in project charter. Working capital, this project has to only complete at this particular cost. Okay, so working capital means the actual fund the company has to invest on the project. And one of the item in project charter will be the initial cost which has been allocated for the project, and the project manager will do employ all his techniques to before the project is get approved, before the project is get signed, he will match the cost which has been declared in the project charter. He will employ all the crashing techniques. He may maybe cut some scope, cut some quality, but the project will only get selected if the cost which has been declared in the project charter is the actual cost. The cost baseline is the same. If there is a huge difference, the project may not even get approved for the execution phase. So that's the working capital which the company has to invest on the project. Also understand depreciation. What is the depreciation? You probably know depreciation. There are two types of depreciation in project. So depreciation means that every product which even if your mobile phone, your product, you bought a mobile phone for $10,000, and over a period of after 1 year, the if you're trying to sell the mobile phone, the value, you will not get the same value as a return. You may only get 8,000 or maybe 7,000. So the value which is loses, that is the depreciation over a period of time. So purchase larger assets purchased by a company loses value over a time. Okay, accounting standards call this depreciation. Okay, so there are multiple methods called straight line depreciation. What does the straight line depreciation means is the same amount of every year the same amount of value get depreciated. For this example, if a 1,000 item with a 10 year of useful life and no salvage value, the salvage value means how much the item is worth at the end of the life. So suppose that a $1,000 mobile phone, after 10 years it has suppose zero return, maybe end of life. There will be no value for it after the 10 year. So 1,000 worth of mobile phone of 10 year of useful life would, if it depreciated by it will be depreciated 100 per year. So that's called every year in straight line depreciation. So it will be $100, $100, and after 10 years it will have no value. So that's called every year the same amount of value will get depreciated. On the other hand, there is another term called accelerated depreciation. In this depreciation, it depreciates faster than the straight line depreciation. So what will happen? The same mobile phone of $1,000 for 10-year useful life, maybe the first year it will depreciate by $180. The second year it may depreciate by $150. So the depreciation is not maybe the higher for the first $180 than $150, and maybe at the 10th year the depreciation value maybe only $10, $20. So accelerated depreciation, it depreciate faster than the straight line depreciation. Any query on this depreciation, guys? Anybody, please raise hand. So Adiyami, would you like to I'll just unmute you. Is any
Yes, I have a question.
Yeah,
I have a question. Can you hear me?
yeah, I can hear you.
In the second aspect, the accelerated depreciation method, is there any percentage attached to it that you need to take out the salvage value every year?
It depends.
Because I can see
Actually, there is no fixed formula for it that in the first year it will depreciate by 30% and then 20%. It depends. It depends of the product and depends on the the demand for that particular product as well. But just try to understand. But the depreciation is uneven. It is not every year. It is not that the depreciation will be of the same value. So that is the concept. So there is no fixed formula that the first year it will depreciate by 20%. Same if you buy a car, if you buy a new car, so it depends on the that particular economical situation or market condition. But depreciation at the first year maybe depreciate by the greater value, and after 3-4 years the depreciation will be slower. So it depreciated unevenly, but it is a faster depreciation than the straight line depreciation.
Okay.
Hope that's clear.
Yeah. Is this the same thing you call zero depreciation method?
No, this is not zero depreciation method. It is called accelerated depreciation. You may see some of the questions on your PMP exam also on accelerated depreciation. The exam may simply ask you accelerated depreciation which is the faster depreciation method, accelerated depreciation, straight line depreciation, or that you may have to answer that accelerated depreciation is the product is depreciated faster in if it is the accelerated depreciation.
Okay, thank you.
Yes. Anybody else, guys? Any queries? So this is the another concept which is used during the project. Okay, if the project is halfway and halfway gone through in an execution phase, and it has already over exceeded the fund which has been allocated. So this is the concept of behind sunk cost. Should you stop the project at that particular point of time, or should you continue with the project of time? So let's understand. Sunk cost is basically the cost which has already been spended or expanded on that particular project. Okay. So let me put this question, and let me then give you an example. Let me understand from you how much you understand by this particular question. An organization has a project with an initial budget of 1 million. So this is the 1 million maybe budgeted in the project charter. As I said, project charter will have the initial project budget, the project cost, the constraints, the assumptions, as well as your payback period and all those things. So on a project charter, the fund was allocated for the project was 1 million, and the project is halfway through the execution phase and has already spent it to 2 million. Should the organization consider the fact it is already 1 million over budget, and should this be a criteria to stop the project? If the project is halfway through and it is already over budget, should the project be stopped at this particular point of time? Anybody? The sunk cost means it has already spent 2 million, so it is the expanded cost. But should we consider sunk cost as to stop the project at this particular point of time? I'm not having any new people. Anybody? I would like to have some more people participating in this webinar. Should sunk cost should be considered for project to continue project or not? Let me have Chandra this time. Chandra, can you hear me out?
Yeah, I can hear you, but it's a little bit noisy in my environment. But I will quickly answer the question.
Yeah, please.
It is not the sunk cost that determines whether to continue or not. It's actually how much more money required to sustain the project. That will be the deciding factor.
Great. Thanks, Chandra. So,
Thank you.
Yeah. Anybody else, guys? Chandra is absolutely right. Would you like to give me some more example? He's right in saying that sunk cost should not be considered whether to continue with project or not. Okay. Okay, let me have Mr. War, I have unmuted you. Would you like to throw some more light on sunk cost?
Yeah,
Why
actually I agree with the fact that we should have to consider the sunk cost also. But in this case, the cost is the sunk cost is almost same or more than that expected cost. So we have to rethink about this one. I think in this particular case, I think.
Okay, no, I'm not able to understand. Why should we not consider sunk cost? If
See,
my
actually that initial cost was only 1 million.
yeah,
And the sunk cost is it's going to more than that 1 million.
yeah,
Okay, at this time we have to rethink about, because it is, I think it can be some fraction of initial budget. The sunk cost should be, it should not be more than that.
okay. So so uh, uh, so let me tell you. See, maybe the project is initial budget was allocated by the organization as $1 million for the project, and halfway through you have done your earned value calculation, and you find out that you have already over budget. You have already spent 2 million, and you are already 1 million over budget. But is the cost is the only factor the project should be considered to get stop or to continue? No, there are many other constraints on a project. The constraints may be the schedule, the scope, the customer satisfaction, the quality, all those things. So maybe the cost may be 1 million over budget, but it may be still be giving me at the end of the project completion, be giving the benefit for which the project has been initiated. Maybe there may be some government regulation. So after the project has been initiated for $1 million, the project has expanded additional $1 million, but that should not be the criteria that the money which has been spent, additional money has been spent, the project should get stopped. No, because it may have some other constraint or some other value attached to the project, which may be having the greater value over the cost. Okay, so as I said, there may be the government regulation, or maybe it may be at the end, if we even are able to complete the project of over $2 million additional value, but I'm still able to get my return on investment in 6 months or maybe in 8 months. So that's the concept behind sunk cost. Means you should not consider the cost which you have expanded. So you should continue with the project if it meets the other objectives of the projects. Do you agree, guys, with this justification? Sunk cost should not be considered to decide whether to continue for the project or not. It should be the other constraints of the project or other objectives of the, if the project still meets the objective of the project, it should be continued. Hope that that makes sorry. Okay, so no, the money spent is gone, so you should not look at the money which has gone. I have a raised hand from I'll not be able to pronounce Ol. Ol, can you hear me out?
Yeah, yes, I can. Sorry, I have a question on the sunk cost.
Yeah.
If you've been monitoring your project, I guess I'm finding it difficult to understand how you be $1 million over budget.
Yeah. Sorry, I'm not able to understand you. Can you please repeat that?
Yeah, sorry. My question is more of if you have $1 million as a project.
Yeah.
And halfway through the project.
Yeah.
You spent over $1 million. You spent $2 million.
Yeah.
I guess I'm finding it difficult to understand, if you've been monitoring the project, how you spent over $1 million halfway through the project. Should you know have found out at a point during your monitoring process that you're actually going way beyond your budget?
You are absolutely right. You may be, as I said, you may be going over budget, but as I said, maybe budget maybe not the not be the primary objective of the company. Company may still be good to continue the project by putting additional $1 million if it is if it meets the strategic objective. So the strategic objective may be some social cause, or some the objective of the project may be some long-term planning. So maybe even putting some additional value you some point of time. So ultimately the project is not only looked from one constraint, it should be looked from multiple constraints. And if project is it is able to deliver the initial objective, or the if it is still aligned with the strategic objective, that project should be continued to continue for the remaining of the life. Okay. So sunk cost should not the funda behind sunk cost is basically the cost which has been already spended on the project, but that project may still be aligned, the project may still be aligned to the project the organization's strategic objective. Okay. Okay, let me put a small things for you. So which project will you select if the net present value is 200,000, or again missed a zero here, or project B of 180,000? So which project of you if you choose among project A or B if the net present value? Anybody? Can somebody quickly tell me the formula? Remember the formula also of the present value formula? Anybody? Let me unmute Sheikh. Sheikh, can you hear me out?
Yeah, yes, hi.
Yeah. Please tell me, Sheikh.
Hello?
Yeah. Please go ahead. So first of all, tell me which project among project A or project B will be selected here?
Here we will select project A.
Project A. Okay. Do
Yes,
you remember?
because it has higher present value.
Okay. So do you remember the formula for present value? How will you calculate present value?
Yeah, it's nothing but future value divided by 1 plus discount factor in terms of number of years.
Great. So here in case if I say if you are getting 200,000 in 10 years, and you are getting one project B is getting 180,000 in 1 year, so still you will go ahead with project A or project B?
Still, I will go with project A only.
Project A only. Great. This is what I want trying to understand is this in net present value. If a project A has net present value of 200,000 and project B has a net present value of 180,000, irrespective of I'm getting 200,000 if in the question if mentioned, because that number of years has already been calculated, has been considered in net present value formula. So if the exam question asks you, or if any of the ask you the question, you should go ahead with the project which has highest net present value. Okay, great. Thanks, Sheikh. Okay, internal rate of return. Which project you should select? Internal rate of return, project A or project B? Anybody? Can I randomly unmute anybody and would like to understand? Let me unmute this time. Garrett, can you hear me? Hello, Mr. Garrett. Okay. So anybody would like to say which project will you select? A project A for internal rate of return of 10% and project B with project 18%. Let me unmute Ranita again. Ranita, can you hear me out?
Yes. You would go with the 18% project B. No calculation is needed. You would opt for the greater investment rate of return.
Okay. So can you quickly also explain me the definition? What is the return, internal rate of returns? What do you understand by internal rate of returns?
It's the return that is, well, it's returned back to the investor. It's the
Great.
percentage of return that is returned back to the investor.
Absolutely right. So that means if there are multiple projects in the organization and one project is saying my return on investment is 10% and another project is saying my return on investment is my return is 18%. So the committee or the project selection committee will select a project with highest rate of returns. That's really great, Ranita. Thanks. Okay, so what is payback period? Payback period, and which project will you select? With highest payback period or with lowest month of payback period? Let me have Adelaide this point of time. Adelaide, can you hear me out? Hello, Mr. Adelaide? Okay. Okay. Chandra would you like to answer which project you will select, a project with 20-month payback period or project with 15-month payback period?
It is 15 months payback period. It's the earlier the better.
The
But I
earlier
would
the
like
better.
to,
Yeah.
yes, just one more point.
Yeah.
Earlier there was a question that regarding $2 million being spent and one I
The
guess
sunk cost. Yeah.
someone was asking he is not able to understand it because the project is being monitored how it went over budget and still it's not noticed.
Yeah.
I just had a thought on that. So it's actually it may be between the monitoring period or something like that. Maybe
Right.
consider Apple or Samsung. Somebody sued over a project or
Yeah.
something like that, and there was a legal obligation, and you had to suddenly pay out $1 million or something. So I was just thinking about that. That could have resulted in over budget.
Yeah, definitely there could be many reasons the project can go over budget. But it is this project selection committee has to understand which is the every project, as has many constraints: cost, schedule, scope, customer satisfaction, quality. So if the important factor for the project is selected not because all the project is selected because of some objectives behind that project, the strategic objective. If the project is still meet by overspending $1 million or maybe double the cost which has been initially budgeted, then also if it still project meets the strategic objective, so that strategic objective is the key factor for the project, because project has to achieve something for the organization or for the society. If that still aligns with that strategic objective, that project should be continued. Should not think that what money has already been spended or expanded on that particular project. Okay, so that sunk cost, the cost which has already been expanded, maybe double or maybe even thrice. But if the project still meets the objective, if it meets the other constraints, the project should continue. So that's the concept behind the strategic objective of the project. Definitely, cost is one of the important factor for project to continue or not to continue. But should not be the solely one factor to decide to continue or not to continue. Benefit cost ratio. So which project will you select? Benefit cost ratio of 1.67 or 3.45? Ramaya, would you like to answer this? Ramaya, could you hear me out?
Hello?
Yeah, Ramaya, can you hear me out?
Yeah, I can hear you.
Yeah. So can you please tell me which project will you select? A benefit cost ratio of 1.67 or a benefit cost ratio of 3.45?
Benefit cost ratio is the revenue minus the cost, so we go with project B, 3.45.
Great. So this is this ratio basically. Okay. So it is not minus. It is uh, uh, ratio is always something by divide by something. Let me Ramaya correct you. So my returns may be
Sure.
suppose my returns may be suppose $300,000. My cost may be suppose 100,000. So my benefit cost ratio will be depend on the division, not on minus basically. Okay. So
Okay.
you're absolutely right. You're absolutely right. Benefit cost ratio of 3.45. That means my benefit is is higher than my cost. So if there are multiple projects are going on in an organization, it has been nominated, you will select as a project selection committee member. You will find out which project has the highest benefit cost ratio, that which project if I am spending I'm over I'm putting a money of $1, how much I'm getting return for that particular $1. So that's the concept of benefit cost ratio. So great, thanks Amaya.
Oh,
Yeah. So
thank you.
this is what I wanted to cover in today's webinar, friends. Project manager has to understand these terms, benefit cost ratio, payback period. These terms are not only used for project selection, but during time management knowledge area, in the cost management knowledge area. These analytical technique are used during during planning process, plan cost management and plan schedule management, to check whether the company can still after planning is completed, the original it is able to achieve the original budget or not. So these some of the payback period or the benefit cost ratio. The company may have initially declared the payback period, it wants the return on 6 months, but after planning the project, if the planning the entire cost, if the project manager identifies no, this project will not be able to meet the initial cost or the initial objectives, so then he should immediately go to the selection committee and should say that, boss, this project will not be able to achieve that particular strategic objective or maybe the cost objective. Okay. So that's what project manager has to understand. What are all these terms, how this value has come, so that he can, during the planning process, he can match this value, and he can go back to the selection committee that this is the actual value or this is the actual cost the project will have, the project life cycle will have, the project life cycle cost, the original cost which has been given or has been declared in the project charter is not be able to is not the cost in which the project can be completed. So that's the today's topic of project selection. Thank you very much, guys. I hope you able to understand some of these concept of project selection, and you able to do justification to your project going forward. Thanks, Raj. You can take it from here, and if any questions, I would definitely like to take it.
Sure. Sure, Kailash. So folks, if you still have any queries, you can ask your question in the question panel, or you can click on the button raise hand. In the meantime, let me take back the access and let me share some details of VizLabs. So I hope you're able to see my screen. Kailash, can you please confirm?
Yes, I can see.
All right, great. So folks, this was the demo session of our PMP virtual classroom training, which we do every month. I just want to tell you a little bit about VizLabs, who we are, what we do, and what was the purpose of today's webinar. VizLabs is an IT certification preparation company, and we are serving IT certified people and the project management people since 2000, and more than 2 million plus users have succeeded after using our products. And if you can see, like the success rate is 99.7%. We also have some corporate customers. You can see the logos. It's like Cisco, Accenture, JP Morgan, TCS, Infosys, Wipro, and there's a long list. So let me proceed with the next slide. So the purpose of today's webinar was to help you to know how we conduct our 4 days virtual classroom training. So like this today's webinar, we do conduct
Muted.
Training on weekends, and this training is for 4 days, like Saturday, Sunday, then next weekend, Saturday, Sunday. And the only difference is in the real classroom training, all the participants can talk with the trainer, they can talk with each other. In the webinar, we have muted intentionally so that there should not be any disturbance.
Thank you for watching this video. Please visit our website www.wizlabs.com and take a sample practice test. You can also contact us by any of the following means. All the best.